external sector in India refers to the country's economic interactions with the rest of the world, including trade, imports and exports, investment flows, foreign direct investment, foreign portfolio investment, remittances, external borrowings, and foreign exchange reserves. The external sector plays a crucial role in shaping India's overall economic performance, influencing growth, inflation, and exchange rate stability. Here's an overview of the major components of India's external sector. 1. Foreign trade, exports and imports. Exports. India is a major exporter of goods and services, including petroleum products, textiles, pharmaceuticals, gems, and jewelry. The country's services exports, such as information technology, IT, business services, and outsourcing, are particularly significant. Imports. India imports a wide range of goods, including crude oil, gold, electronics, machinery, and chemicals. The country's dependence on oil imports makes the oil prices highly significant for India's trade balance. 2. Foreign direct investment, FDI. FDI refers to investments made by foreign entities in India, either by acquiring a stake in a domestic company or by setting up new ventures. India has been one of the largest recipients of FDI, with sectors like technology, telecommunications, manufacturing, and retail receiving substantial inflows. FDI inflows contribute to the country's economic development by creating jobs, enhancing infrastructure, and promoting technology transfer. 3. Foreign portfolio investment, FPI. FPI consists of investments in India's financial markets, stocks and bonds, by foreign investors. These investments tend to be more volatile but contribute significantly to the liquidity of Indian markets. The stock market and bond market in India attract significant FPI, which can have a substantial impact on the Indian rupee's exchange rate and the broader financial market stability. 4. Remittances. India is one of the largest recipients of remittances in the world, largely due to its large diaspora, particularly in the Middle East, North America, and Southeast Asia. These remittances contribute significantly to the country's foreign exchange reserves and are a vital source of income for many households. 5. External borrowings and debt. India borrows from international markets and institutions to fund its development projects. These borrowings come in the form of loans from foreign countries, multilateral institutions like the World Bank, and through issuance of bonds in international markets. External debt management is crucial to ensure that the country's debt remains sustainable and does not negatively impact its creditworthiness. Foreign exchange reserves. India maintains a stock of foreign exchange reserves, which are assets held by the Reserve Bank of India, RBI, in foreign currencies. These reserves are crucial for stabilizing the rupee and ensuring that India can meet its international payment obligations. The reserves consist of foreign currency assets, gold reserves, special drawing rights, SDRs, and reserves with the International Monetary Fund, IMF. Exchange rate management. The exchange rate of the Indian rupee against major currencies like the US dollar, euro, and others is influenced by India's external sector. The Reserve Bank of India, RBI, intervenes in the forex markets to manage excessive volatility and ensure that the rupee's value remains relatively stable. India follows a managed floating exchange rate system, where the currency is allowed to fluctuate within certain limits based on market forces, but the RBI occasionally intervenes to avoid extreme fluctuations. The BOP is a record of all economic transactions between India and the rest of the world. It consists of the current account, exports and imports of goods and services, capital account, investment flows, and financial account, loans and foreign investments. India has traditionally run a current account deficit, SAT, meaning the country imports more goods and services than it exports, which can lead to external vulnerabilities. However, capital inflows, such as FDI and FPI, typically offset this deficit. India's external sector is shaped by its trade policies, including tariffs, quotas, and trade agreements. India is a member of the World Trade Organization, WTO, and has bilateral and multilateral trade agreements with various countries. India is increasingly focusing on regional trade agreements, such as the Regional Comprehensive Economic Partnership, RCEP, to enhance its trade relations and integrate into global supply chains. Challenges and opportunities. Challenges. India faces challenges such as rising global protectionism, dependence on oil imports, trade imbalances, and the need to diversify export products and markets. The volatility of foreign investments and the risks associated with global economic uncertainties also pose challenges. Opportunities. India has vast potential to enhance its exports, particularly in services, manufacturing, and agriculture. By improving ease of doing business, upgrading infrastructure, and boosting its innovation and digital economy, India can further integrate into the global supply chain. In summary, the external sector in India is a key driver of the country's economic growth. Maintaining a balance between imports and exports, managing foreign investments, and ensuring stability in the foreign exchange markets are vital for India's long-term prosperity.